Hey everyone, welcome back to Corporate Decoder. Today CCT is filing an 8K detailing their IPO and private placement, and I am seeing a clear sign of how SPACs typically operate. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing shows the initial fundraising and setup for this company. And understanding how this money is handled is key to the whole SPAC game. So the main event here is reporting on their initial public offering or IPO. This is when a private company first sells its shares to the public. For Columbus Circle Capital Corp. 3rd, this happened on the 10th of July, 2026. They offered 23 million units and each unit came with a share of stock and a piece of a warrant. They sold these for $10 a unit, bringing in a cool $230 million. One of the key things to understand about these units is what comes inside them. You get one share of what they call Class A ordinary shares. Think of these as the basic voting shares of the company. Then you also get 1/3 of a redeemable warrant. Now, what is a warrant? It is like a coupon that gives the holder the right to buy a stock at a set price in the future. In this case, each of these warrants can be used to buy one Class A ordinary share for $11.50. The filing also mentions a private sale of units that happened at the same time as the IPO. This is called a private placement. They sold an additional 665,000 units this way, with most of them going to the company's sponsor and the underwriters, the investment banks helping with the IPO. These units were also sold at $10 each, bringing in another $6.65 million. Now, here is a really important part for any SPAC. All the money raised from both the IPO and the private placement, a total of $230 million, was put into a special trust account. This is a common practice for special purpose acquisition companies, or SPACs. The money stays there until the company finds another business to merge with, which is the whole point of a SPAC. If they don't find a deal, the money is supposed to be returned to the investors. The company is also identifying itself as an emerging growth company. This means they are a smaller company that has recently gone public and will have some regulatory advantages, like being able to delay following certain accounting rules. This is pretty standard for newer public companies. The main story here is the closing of the IPO and that massive fundraising. They've raised a significant amount of money as expected from a company going public. This is the initial step, and now all eyes will be on Columbus Circle Capital Corp., the 3rd, to see what target company they will acquire. They've also included an audited balance sheet from that IPO date. This document would show the company's assets, liabilities, and equity right after they received all that capital. It confirms the financial snapshot from the IPO proceeds. Looking at the bigger picture for companies like this, SPACs are designed to bring companies public faster, and sometimes with less scrutiny than a traditional IPO. However, there is a lot of risk involved. Many SPACs end up not finding a good acquisition target, or the merger they do pursue doesn't work out well for shareholders, leading to significant stock price declines. We've seen many SPACs perform poorly in the years following their IPO, for example. After the initial SPAC boom, many companies that went public through a SPAC merger saw their stock prices drop by 70 to 90% within the first year. The key challenge for Columbus Circle Capital Corp. The 3rd will be to identify and successfully merge with a promising operating business. The report is signed by Gary Quinn, who is listed as the Chief Executive Officer. This indicates the leadership team that will be guiding the company's search for a merger target. Overall, this filing is a confirmation of the initial fundraising for Columbus Circle Capital Corp. 3rd through its IPO. It is the very beginning of their journey as a public company. The real test will be their ability to find a suitable business to merge with and create value for their shareholders. The significant amount of money and trust is a good start, but the success of any SPAC hinges on the execution of the merger and the performance of the combined entity. Now, looking at the broader market activity, there are headlines from around the time of this filing that touch on competitors and insider bets, suggesting some investor interest in this space. One headline mentions a substantial insider bet from the sponsor, which can sometimes be a signal of confidence. Another talks about book value per share, which is a way to assess the underlying worth of the company's assets. The primary risk for a company like this is always the deal. Making itself, they have the capital, but finding the right company to merge with at a fair valuation is a complex process. If they overpay or merge with a business that underperforms, the SPAC structure can lead to significant losses for early investors. What I'm actually looking for is the announcement of their merger target and the details of that deal. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take, stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.